Every nation on earth is drowning in debt. The United States, the wealthiest country in history, owes more money than it can count. Japan's debt is larger than its entire economy. Europe, Asia, Africa, every government is buried under numbers so large they no longer feel connected to reality. And yet, the global financial system keeps functioning, like a plane flying with its wings on fire. But the true nightmare is not the debt itself. It's the realization that the world borrowed from nobody, or rather, from itself. There is no shadow empire of trillionaires with vaults full of gold, no secret dynasty demanding repayment. When you trace the claims, when you map who owns the obligations, you discover that modern debt is a circular construct. An internal loop where governments owe institutions, institutions owe investors, investors owe funds, and funds rely on governments. A closed circuit, a trap. But how did such a system emerge? How did debt stop being a temporary burden and become the core architecture of global finance? The answer leads to four men, each separated by decades, each solving a problem of his era, each laying another brick in an edifice that became impossible to dismantle. They weren't conspirators in a dark room. They never met. But their ideas connected, reinforced one another, and eventually merged into the unstoppable machinery we live under today. A machinery that turns government IOUs into money. A machinery that converts crises into profit. A machinery where interest never stops flowing upward. Understanding it requires going back to the moment the world's first permanent national debt was engineered. A move so radical it changed how nations functioned forever. Because once that mechanism was built, there was no turning back. And the first architect was a man almost nobody remembers today. Before the late 1600s, monarchs borrowed like gamblers, recklessly, inconsistently, and with consequences. If a king couldn't repay, he defaulted. Creditors took the loss, the king faced embarrassment, and the cycle restarted, crude, chaotic, and finite. Then came William Paterson. A Scottish merchant with a history of failed ventures, Paterson arrived in London with an audacious idea at the precise moment England needed salvation. The nation was broke, locked in a costly war, and traditional lenders refused to provide more funds. England's credit reputation was destroyed. The king was desperate. Paterson offered a lifeline, but with a twist that would change financial history. He proposed a loan so large it seemed impossible for its time. But his real innovation was not the size of the sum, it was the terms. The principal would never be repaid. Ever. Instead, the government would commit to paying perpetual interest, guaranteed by taxes. In exchange, Paterson proposed creating a central institution to manage the arrangement. Thus, the Bank of England was born, not as a bank serving the people, but as a machine ensuring the government's eternal interest obligations. The move was revolutionary. The government received the funds it needed. Wealthy lenders received steady interest payments backed not by risk, but by the Crown's taxation powers. Parliament approved the structure, and for the first time in world history, a national debt became permanent. But Paterson's genius didn't end there. The bank was granted the power to issue paper money backed not by gold, but by government debt. The IOU of the state became the foundation of the currency. Debt was no longer a burden. It was fuel. The more the government borrowed, the more money the system could create. And from that moment, the idea of repaying the principal vanished from economic reality. It was the birth of the modern debt trap. And the next architect would scale Paterson's invention from a national mechanism into a global one. By the early 1800s, Europe embraced government borrowing, but it was messy. Loans were fragmented, inconsistent, and limited. Nations could still default without triggering catastrophe. Debt was permanent, but not inescapable. Nathan Rothschild changed that. Operating from London, Rothschild built the first truly international financial network. His couriers could move information faster than diplomats. His capital could cross borders in hours, and his influence reached into every major court in Europe. But his real innovation was not speed, it was structure. Instead of lending directly to governments, Rothschild bought bonds in bulk, then sold them across a continent-wide investor base. That created a secondary market, turning government debt into a liquid asset. It meant anyone, from aristocrats to banks, could own a slice. This was the pivotal shift. Because once sovereign debt became widely distributed, default was no longer a dispute between a monarch and a creditor. It became a systemic threat. If Britain defaulted, it wouldn't just hurt one lender. It would devastate French investors, German banks, Austrian funds, and entire economic networks. Default ceased being an option. Rothschild turned national borrowing into an international web of financial interdependence. Every bond payment supported the stability of the entire system. Every new issuance spread the web wider, and every crisis strengthened Rothschild's influence because governments needed him to access the network he controlled. He industrialized government debt, he globalized it, and he made it too interconnected to unwind. Now governments not only borrowed forever, they were trapped forever, but the next architect would take the system even further, solving a problem neither Paterson nor Rothschild could, the natural limits of money itself, because the system was about to gain the power to create money out of thin air. At the start of the 20th century, America was on the rise, but its financial infrastructure was dangerously fragile. Banks operated independently, money supply was tied to gold. Markets crashed often, and government borrowing was constrained by how much capital those banks actually held. Then came the panic of 1907. Markets collapsed, banks failed, fear spread. And only one man had enough personal power to stop the bleeding, J.P. Morgan. He locked the nation's top bankers in his library and forced them to pool their money to prevent economic collapse. It worked, but the message was clear. One private banker should not have this much control. So Morgan designed a system that would give his class that control forever, without appearing to. In a secret meeting on Jekyll Island, his associates drafted plans for a new Federal Reserve System. Not a central bank, Americans hated those, but a decentralized-sounding network of regional banks. It was theater, a brilliant one. The real design placed monetary creation power in the hands of institutions influenced by the same banking elite. And the most critical function, buying government bonds with newly created money, was concentrated in the New York Federal Reserve, effectively Wall Street's domain. This changed everything. Now the U.S. government had a guaranteed buyer for its debt. There was no longer a natural limit to borrowing. The Federal Reserve could simply create new money to purchase Treasury bonds the moment they were issued. Government spending became infinite. Debt became infinite. And interest payments became an eternal stream flowing upward into the financial system. Morgan didn't live to see the full consequence of his creation, but his design is what allows today's $38 trillion U.S. debt to exist at all. And yet, even infinite debt wasn't the final evolution. The next architect made the system truly global and truly impossible to escape. By the 1970s, the developed world was addicted to borrowing, but the developing world operated differently. Emerging nations borrowed for growth, not maintenance. Their debts were meant to be temporary. Then inflation surged. The dollar weakened. Confidence evaporated. The Federal Reserve Chairman, Paul Volcker, responded with the harshest monetary shock in modern history. Interest rates raised to levels so extreme they crippled global finance. Loans taken by developing countries at low rates suddenly tripled in cost. Mexico, Brazil, Argentina, they all approached the same fate, default. But default would have crushed American banks that held those loans. The global system was threatened. So instead of letting the market clear, Volcker set in motion a new mechanism, a mechanism that weaponized debt. The IMF stepped in, not to forgive the loans, but to refinance them, over and over with strict conditions. Countries had to surrender economic sovereignty, cut spending, sell state assets, open markets, devalue currency, redirect national policy to satisfy creditors. Debt was no longer just permanent or interconnected. It was leverage, a tool of control. Volcker ensured that even when nations couldn't pay, they wouldn't be allowed to exit the system. Their debt would be rolled over indefinitely, just manageable enough to continue paying interest. The trap became global, and from this moment on, the world's financial order was locked into a structure where every crisis fed the same machine. But the most shocking part was still to come, because the trap didn't just apply to nations, it applied to everyone. Today, sovereign debt is not a ledger between lender and borrower. It's a vast, tangled network of claims so intertwined that the system can't function if any major piece collapses. The U.S. government issues trillions in bonds. Domestic institutions buy them with citizens' savings. Foreign nations buy them as reserve assets. Central banks buy them with created money. Funds hold them as collateral for more borrowing. Banks use them to meet regulatory requirements. Interest payments flow upward from taxpayers to institutions that manage the debt, pension funds, insurers, asset managers, and central banks. Japan's debt is held mostly by Japanese institutions. Europe's by European banks and the ECB. China's by state banks. And yet, Japan holds U.S. debt. The U.S. holds European debt through multilateral institutions. Europe holds developing nation debt. Developing nations hold Chinese debt. The entire global economy is a circular chain of obligations powering itself through perpetual borrowing. And here's the final kicker. If governments tried to pay off their debt, the money required to do so would disappear from the economy. Debt is the money supply. Remove it, and the system implodes into depression. Debt must grow for the economy to function. The system is addicted. There is no exit ramp. And the beneficiaries? The asset managers and institutions that own the bonds, BlackRock, Vanguard, State Street, Fidelity, they control trillions. They collect interest funded by workers. They benefit from every crisis, every bailout, every refinancing. Debt doesn't oppress nations. It extracts from them. But the deepest truth is still ahead, because none of this was accidental. Paterson made debt permanent. Rothschild made it global. Morgan made it infinite. Volcker made it inescapable. 4 men in different centuries solved different problems, each in ways that strengthened the same system. Debt became the foundation of modern civilization. Interest became the rent humanity pays to exist inside that structure. Governments don't control it. Taxpayers don't benefit from it, but everyone participates in it. So when you hear someone say, the national debt is a problem, understand? The architects never intended for it to be solved. And the debt is the system. The interest is the product. And the world you live in, your economy, your taxes, your savings, your currency, exists inside their design. The trap isn't failing. It's working flawlessly, exactly as they built it. The only question now is whether the world will continue feeding it, or whether the next crisis finally pushes the machine beyond its limits.